welcome to our yet another discussion on the accounting and preparation of financial statements of a partnership business. In this very video, I take you through the accounting treatment where we have a partner retiring and then we have another partner that is admitted into the partnership. So this is a very good example that demonstrates two things at the same time. That is retirement of a partner and admission of a new partner into the business. We are required to prepare for ABC the revaluation account, the partner's capital account, the bank account, the individual asset account, the goodwill account, and the statement of financial position for the new partners, Bonnie, Charlotte, and David. So, of course, before you begin on that, you have to look at this additional information. We are told in the additional information that on the 31st of December 2018, Bilinga retired. Okay, that is now an adjustment in the partnership. Bilinga retired, and the remaining partners decided to admit David on the same day. David was to contribute 12 million as capital. Bonnie, Charlotte, and David agreed as follows: to share profits or losses in the ratio of 2 to 3 to 5, to maintain fluctuating capital accounts. Have you seen this one? This is what I mentioned, that it will keep on coming, so you should know what are fluctuating capital accounts. Now we have mentioned that under this method we maintain the same what? We maintain the current and the capital accounts in one what? In one account. Number 3, Bonnie, Charlotte were supposed to increase their capital contributions by 20% and 50% of initial capital contribution respectively. So Bonnie is supposed to increase his by 20%, Charlotte is supposed to increase hers by 50%. So that would be the first journal entry I would consider here. Okay, I'm going to put my journal entries right here, and of course I'll begin with that very first one, which is the increase in capital contributions. So we are told that Bonnie is supposed to increase his capital contribution by 20%. So the question would be, how much is Bonnie's capital contribution? How much is Bonnie's capital contribution? So when you look at our question here, you see that Bonnie's capital contribution under the capital account, just down here, this is the place that is going to give me the answers. Bonnie's capital contribution is 10 million, whereas Charlotte's capital contribution is 5 million. So Bonnie is going to increase this one by 20%, and then Charlotte will increase this one by 50%. So depending on how you calculate it, this would suffice. Of course, Bonnie, that would be 20%, that's the 10 million, times 1.2. 1.2 is the 100 plus 20, 100 plus 20, divided by 100, that will give you 1.2. So ideally, Bonnie's capital contribution is going to now increase to 12 million, the original 10 million and the increment of 2 million. Similarly, Charlotte is supposed to increase hers by 50%. So 100 plus 50, that gives me 150, divided by 100, that's 1.5. So that's the 1.5 you see right there. So in essence, Charlotte's capital now will rise to 7.5, the original 5 million and the additional 2.5 million increment. So basically the accounting entries, you would ideally debit the bank account, because this money must come to the bank account. The bank account 4.5, which comprises of the figure for Bonnie, which is 2 million, and then the figure for Charlotte, which is 2.5 million. So at the end of the day, our two sides of the journal will balance at 4.5. So we are receiving 4.5 million as a result of the additional capital contribution from Bonnie and Charlotte. Then let's move to the second additional information given to us. When you move to the second one, and in number 4 we have the value. We are saying that the value of goodwill at 4.5 million. Okay, they value goodwill at 4.5 million and account for it using the revaluation method. Revaluation method is among those methods I mentioned. I mentioned that in partnerships, goodwill is maintained under 3 major methods. We have the premium method, we have the revaluation method, we also have the memorandum method. So the examiner has chosen this one, revaluation method. And in this one here, as we discussed, we mentioned that under the revaluation method, what's going to happen is that we shall maintain the goodwill in the books of accounts. So that one you can mention to the examiner as you're trying to indicate the journal entries you're going to pass. So in our number 2, we have the goodwill coming in, and we are saying that under the revaluation method, the goodwill account is opened and is debited with the goodwill arising. Okay, it debited with the goodwill arising, which is then shared between the already existing partners, using the old profit and loss sharing ratios. So the 4.5, ideally, we are going to share it. We shall open up an account called goodwill account and debit it with the 4.2 million. Then the balance is going to be shared between the partners, so it is going to go to the partners capital account, and of course they are sharing the profits and losses equally. These are the old ones, Bonnie, Charlotte, and Abilinga. They are sharing the profits and losses equally, so each one will receive 1/3, 1/3, 1/3, which ideally gives me a 1.4 million for each of these. So at the end of the day, my journal is going to balance off like that. Okay, my journal will balance off like that. So I'll keep on taking these figures to the various accounts that I'm required to prepare. Next we have this the additional information in our question. In number 5, they are saying that a revaluation took place. Of course, we have agreed on that if there is a change in the partnership, then revaluation of assets is not going to miss out. We have to revalue the assets, and they are telling us that the Xerox digital copier was revalued to 18 million, furniture and fittings revalued to 26 million, motor vehicles revalued to 21,700 million. Now, of course, we say that revaluation, to get a gain or loss, you must compare these new values and the book values. So we mentioned that the formula is to gain or loss on revaluation, we get the new revalued amount minus the net book value. So the net book values are going to be the carrying amounts shown in our statement here. And when you look at our statement, the non-current assets are given right here. Okay, including this photocopy, of course, including the photocopier. So as you can see, the motor vehicles at 25 million, the value is they're saying the value is 21,700. So it means that we have a gain or loss. What do we have for motor vehicles? Is it a gain or loss? That is a loss. All right. Then we are told that the furniture and fittings, 24 million. Book value, the new value is 26 million. Gain or loss? Gain, that's a gain, good. Then when we go to the Xerox digital copier, that's 20 million and the value is 18 million. Definitely that is a loss on revaluation. So taking you back to our Excel sheet, you see that we have brought all those ones here. This is our number 3, where we are going to talk about the revaluation of assets. And of course, asset number 1 is the Xerox photocopier. The Xerox photocopier, the book value is 18, the new value is 20. The new value is 18 minus 20, which is the net book value, giving us a loss on revaluation. So the accounting entries have already been discussed in the notes. We say that if there is a revaluation loss or decrease in the asset value, we debit the revaluation account with that loss and then credit our asset account with that decrease in the value of 2 million. So of course I'm getting the 18 million minus 20 million. So that is on the part of the Xerox copier. When we move to the next asset, our next asset are furniture and fittings. Furniture and fittings, the new value is 26 million, the net book value is 24 million, giving us a gain on revaluation of 2 million. So the accounting entry is to recognize the gain. We debit the asset. We discuss this entry in the notes. Debit the assets and then we credit the revaluation account. So at the end of the day, our journal will have those balances on the debit and on the credit. Next, the next asset that was revalued were the motor vehicles. We were told that the motor vehicles new value is 21.7 million minus 25, which gives us another loss on revaluation. Just like we did for the Xerox machine, we shall debit the revaluation account with the difference of 3.3 million and then credit our asset account with the 3.3 million. At the end of the day, our journal will have those balances on the debit and on the credit. So there I will have handled the issue of revaluation. Next we have our note number 6, and in note number 6 we are told that Bilinga took one of the laptops whose book value is 1.8 million. He took it over at the same amount. Now yes, it is a practice in partnerships where partners take over assets, especially if they are retiring. So if an asset is taken over by a partner, what we are going to do, as you can see in my note number 4 here, in my adjustments number 4, takeover of the laptop. So as he has mentioned, we debit the person, a Bilinga's capital account, and then we credit the asset account because you know the assets are decreasing whereas this guy is benefiting. Perfect. So our entry will look like that on takeover of the laptop. Alright, we move to the next, number 7. They are saying that there was settlement of liabilities. Before David joins, they agreed that they settle. The other old partners agreed that they settle the liabilities before David joins. Bonnie was to take over the bills payable in full and 60% of the bank loan, whereas Charlotte was to take over the bank overdraft and 40% of the bank loan. So as you can see in our table here, the bills payable are given right here. You have in the liabilities, bills payable taken over, bank overdraft is also taken over. At the same time, the loan is taken over by the two remaining partners, Bonnie and Charlotte. So let us see. I'm going to get from you some of the accounting entries. Number 5, settlement of liabilities. And begin with the first liability, Bonnie. Bonnie takes over the bills. Of course, we shall debit the bills because they are going to decrease. The bills are liabilities. We debit the bills. At the same time, he's also taking over 60% of the loan. Okay, when you get 60% of the loan value, how much is it? The loan is 50 million, so 60% definitely that would be 30 million. Between me and you, you know, 6 and 5 will give you 30. And then at the end of the day, we shall credit Bonnie's capital account. Bonnie's capital account will increase in value. Then, of course, Charlotte takes over the bank overdraft and 40% of the loan. So we shall have those figures coming in there. And we have, of course, those entries. We shall debit the bank loan, the bank overdraft, and the bank loan 40%, the 20 million, and then credit Charlotte's capital account the takeover of those liabilities. So that is how Charlotte's account will be affected in terms of the accounting entries. All right, next we shall go to our additional information number 8. This one I'll handle it at once in the T account. So overall, those are the accounting entries that will affect our accounts. So we have the first one, increase in capital contributions. Those are the accounting entries. The second one, we have goodwill arising and treated under or handled under the revaluation method. Then we have the revaluation of assets, the Xerox copier, the furniture, the motor vehicles, takeover of the laptop. Then we have settlement of the liabilities by Bonnie and Charlotte before David, the new partner, comes into our business. So we are going to begin constructing our T accounts, and we shall follow what the examiner required us to do. He wanted us to first of all prepare the revaluation account. Okay, 2 million on the furniture goes to the credit of the revaluation account. Perfect. So we have the losses going to the debit side of the revaluation account and the increases going to the credit side of the revaluation account. So at the end of the day, from the discussion we have had, we have mentioned that at the end of the day, this account is closed off by a loss or a gain on revaluation. So between me and you, do we have a loss or a gain on revaluation? It's a loss on revaluation. Perfect. And the loss on revaluation is going to be shared among the three old. Please, in the examination, you may reach a point where you're confused whether it's going to be the old or the new one. So it's going to be shared between the old people, Bonnie, Charlotte, and Bilinga. Okay, Bonnie, Charlotte, and Bilinga are the ones that are going to share this loss, and this loss is going to be shared in their old. Remember, we have two sharing ratios. We have the new one and we have the old one. So we are going to use the old sharing ratios, which is 1 to 1 to 1, 3,300. So Bonnie will take 1/3, Charlotte will take 1/3, Bilinga will take 1/3. So my calculator is giving me 1.1 for all. So at the end of the day, that's going to be our very nice revaluation account as required in part A of the question. Next, we were required to prepare the partners' capital accounts. We were required to prepare the partners' capital account. Now the challenge here is that one of the partners has retired, that is Bilinga. So we shall begin by closing off Bilinga's what? Bilinga's account. And you see the marks are juicy. The marks are juicy. 6 marks. These are very good marks for you. So it means there's a lot of work to be done to get those 6 marks. Now we need to first of all pay off Bilinga so that he can go in peace. Okay, we want him to go in peace, therefore we should pay him off. So I'm going to begin with Bilinga's capital account. So I want you to assist me and tell me, what am I going to put on the debit of Bilinga's account? What am I going to put on the credit of Bilinga's account? The balance of 8 million on the credit side. Good, that's the balance on the capital account. Now also we need the balance of the current account. Not, it's on the debit side. So it is in red, not so. So if it's on the debit side, if a capital account of a partner is in the debit side, it must be taken to the opening balance, debit side of the capital account. Perfect. What else am I going to bring to this account? Of the revaluation. Goodwill. Perfect. The goodwill. On which side? At the accounting entry. Look at the accounting entry we made for the goodwill members. It's on the credit side. Credit side. Have you seen? Credit side. So you are going to put on the credit side right here. Share of goodwill 1.4. Perfect. What else am I bringing to this account? The laptop. Good. I'm going to bring the laptop. That is a figure of 1.8 million. What else am I bringing to this account? Loss on revaluation. Loss on revaluation, perfect, to be on the debit side, and that is 1.1. When you look at our journal entry, you see that when we are doing the revaluation, we were taking the loss on the what? Okay, loss on revaluation. So that is going to come here, and that is all. So we need to clear this man so that he can go happy. When you total up on the credit side, that's 9.4, and on the debit side it is 9.4. So the deficiency is the payment we are going to make through the bank so that this guy can go in peace. So how much are we going to pay him so that he can go away peacefully? He has retired from the partnership. He has retired from the partnership. 5,700, correct. 5,700. All right. Who do I begin with? What are we going to have? Opening balances. Not so. That is very obvious. Opening balances, because we are maintaining fluctuating accounts, we shall have to capture both the capital and the current accounts. So as you can see in the question, those are the figures. Am I right? Bonnie, Charlotte, David, of course, doesn't have any opening balance. Loan taken over. Loan taken over where? On which side? On the credit side. Okay. Settlement of liabilities is there. So, Charlotte. Okay. Now the loan taken over, of course, is 50, is within what Bonnie? I combined these two, settlement of liabilities. So settlement of liabilities, that would be a bit easy for you. It's number 5, what we did. Bonnie settled the loan and the bills. So that is a total of 39,200. Charlotte settled the bank overdraft and the loan, and that is 21,200. So that is going to be taken right here. Okay. 39,200 for Bonnie, 21,200 for Charlotte. All right, so what else am I bringing to the partners capital account? Share of goodwill. So it is only Bonnie and Charlotte that shared the goodwill. 1.4, 1.4. Additional capital. Where do I put it? On the credit, on the debit? On the credit side. Okay. And of course, as we are told, Bonnie brought in the 2 million, Charlotte brought in the 2.5 million, and then David brought in his 12 million capital contributions. All right, we have exhausted the credit side. Now let us look at the debit side. What do you expect to be on the debit side of the partners capital account? What do you expect? Share of loss of revaluation. Good. 1.1 for Bonnie and 1.1 for Charlotte. David does not get anything. So basically that is it. So let's balance off the accounts. What are the balancing figures? What's the balance carried forward? Charlotte, 31,100. David definitely is 12 million. Good. Perfect. So what's the balance carried forward? Now you can give me the balance carried forward. All right, so we have answered with confidence that part of the question. The examiner wanted us in part B of the question to show the partners capital accounts. So next, the examiner wanted us to also prepare the bank account. The examiner wanted us to prepare the bank account. Okay, so the bank account, I've prepared one for you here to fill in, so you can advise me as experts. You're going to tell me what's going to happen. Okay, capital additions correct. Bonnie brought in 1.2, Charlotte brought in 2.5. 1.2 million for Bonnie and Charlotte that. Then David, 12 million, We have the payment we made to Abilinga, not so? We paid Abilinga his money, 5.7, and we are also opening with an overdraft. This account had an overdraft, it was in negative, 1.2. So we are saying Charlotte takes over the what? The bank overdraft. Yes, Charlotte takes over the bank overdraft, 1.2. Our balance carried forward comes to, this one I can see is giving us 17, I think, 17,700. This one is 17,700. 10,800. 10,800. Okay. Now, the statement of financial position will be a very simple one. You just redraft this. Just redraft this one here. But you remove Abilinga. You have to remove Abilinga. You remove the laptop. Remove the laptop because it has been taken. Remove Abilinga and replace Abilinga with David. Okay? Replace Abilinga with David. I'm saying this other part F, statement of financial position. For the individual asset account, these are easy because we already have the journal entries. These ones are very easy. The goodwill, we only have 4.2. The Xerox, you show the Xerox, you show the furniture and fittings and motor vehicle. Because the laptop has been taken, it will no longer be there. Okay, so redraft the statement of financial position just the way it is here. Yes, the motor vehicle is going to be at 21. Okay, let me just put the figures here right now. Okay, I'm saying this 25 is going to be 21,700. The furniture and fittings will no longer be 24, but the new value, which is down here, 26,000. The laptop has been taken over. This one don't put, it will not be there. The Xerox printer, you're going to put 18, not so. The Xerox printer is going to be 18,000. The new revalued amount. Prepaid license, it will be as it is, 3.3. The accounts receivable will remain at 5.9. Now, Abilinga has gone, so you remove him. Replace Abilinga with the David. Okay, you replace replace Abilinga with what? David. Let me just put this one back just here. Just okay. You replace Abilinga with David, and David's figure is how much? David's figure is the figure we are going to pick from the, how much? You're going to pick 12 million. This is the figure you're going to pick right here. This is the figure that we have here. David, balance carried forward 12 million. Charlotte is going to be 30 million. Bonnie is going to be 51,500. So that's what you're going to have here. Bonnie, you're going to put this one is 12 million. Bonnie, we said is how much? $51,500. Then Charlotte is going to be 30,000. Going to be 30,000. Now the next thing is that these accounts are no longer there because we are now managing fluctuating. So these ones I don't expect to see them. The bank loan has gone, it's no longer there. Bills payables are gone. Bank overdraft is also gone. So you have only these items in the new statement. So just rearrange it and make a good one, and you can post it so that